Canada just changed the game in the oil market, and America may be the one paying the price. For years, US refineries depended on cheap Canadian oil, but now Canada is gaining control and keeping more of the profits for itself. American refineries received a deal that no other country in the world could extract from a major oil producer. They purchased Canadian crude at a persistent discount, sometimes $10 below world market price, sometimes $20, occasionally as severe as $46 per barrel every single day, year after year, for 4 decades. Billions of dollars were left on the table by Canadian producers, who accepted the discounted price not because the oil was worth less, but because the infrastructure to send it anywhere else did not exist. That arrangement is ending. The April 2026 data confirms it is already ending. And the numbers now being recorded in Canadian energy markets describe a structural shift in pricing power that American refineries did not see coming and cannot easily reverse. LNG Canada exported 1 million metric tons of natural gas to Asia in April 2026, a monthly record for the facility. Trans Mountain is running at near full capacity, sending approximately 590,000 barrels per day to the Pacific coast. Asian buyers are paying prices benchmarked against Brent, the global crude standard, which trades higher than the American WTI benchmark. Canadian oil sold to a South Korean refinery now generates more revenue per barrel than the same oil sold to an American refinery in Cushing, Oklahoma. Not marginally more, significantly more. The arithmetic that made American refineries the only viable customer for Canadian heavy crude for 40 years has been displaced by infrastructure. One pipeline changed billions of dollars of annual revenue. The pipeline still being built will change it further. The story of the discount requires understanding what Western Canada Select actually is and why it traded at such a persistent disadvantage. WCS is heavy, thick crude produced from Alberta's oil sands, the most carbon-intensive but also the most energy-dense crude in North American production. For decades, the only direction it could travel was south, through pipelines into the American Midwest and Gulf Coast refinery system. When a seller has only one buyer, that buyer sets the price. American refineries set it low. The WCS WTI discount averaged $17 per barrel across 2 decades. In 2018, it reached $46 per barrel. At that level, the Alberta government imposed mandatory production cuts to stop the financial bleeding a government-ordered production reduction on a viable operating industry, because the price being paid for its product had fallen to the point where the economics of extraction were being destroyed by infrastructure dependence. Trans Mountain expansion opened in May 2024. A second pipeline running alongside the original corridor from Edmonton to the Westridge Marine Terminal in Burnaby, British Columbia, adding 590,000 barrels per day of new Pacific Coast export capacity. The moment Canadian producers had an alternative buyer, the discount began closing. The WCS WTI gap fell from an average of approximately $15 in 2023 to under $10 by mid-2025. The Canada Association of Petroleum Producers calculated that Trans Mountain alone narrowed the discount by $3 per barrel, generating an estimated $4 billion in additional annual revenue to the Canadian energy sector from one infrastructure investment, providing one alternative market. The pricing mechanism that makes Asian sales more valuable than American sales requires explanation because it is where the economic shift becomes most consequential. When Canadian crude moves to Asia through Trans Mountain, it is not priced against WTI, the American benchmark that reflects landlocked mid-continent crude dynamics, including whatever WCS discount American buyers negotiate. It is priced against Brent, the global seaborne crude benchmark. Brent consistently trades at a premium to WTI. Canadian oil reaching a South Korean refinery is priced at Brent minus a quality adjustment for the heavy sour grade, not at WTI minus the WCS discount that American refineries imposed for 40 years. The same barrel earns more in Seoul than it earns in Cushing. The infrastructure that made that comparison possible was Trans Mountain. The implications for American Gulf Coast refineries specifically are not symmetric with other categories of American crude buyers. Gulf Coast refining capacity includes some of the most complex and expensive heavy oil processing infrastructure in the world. Built over decades at a cost of hundreds of billions of dollars, specifically to run on heavy sour crude, the grade produced by Alberta's oil sands, and before sanctions, the grade supplied by Venezuelan production. These refineries were not configured for light shale oil. Retrofitting them for a different crude grade requires billions in capital investment and years of operational disruption. They need Canadian heavy crude. They built their entire infrastructure around it. The competitive pressure on that dependence comes from two directions simultaneously. Canadian producers are building westbound export capacity that gives them increasing ability to price against Brent and redirect volumes away from American buyers who refuse to pay competitive market prices. And Venezuelan crude heavy sour, the same grade profile as Alberta oil sands production, is returning to the American market following an agreement between Washington and Caracas for the sale of 50 million barrels to American buyers. CIBC analysts warned in January that Venezuelan supply returning to American refineries could widen the WCS discount in 2026 compared to 2025. That is the competitive threat that makes building additional westbound pipeline capacity urgent rather than optional for Canadian producers. Every month without new Pacific export capacity is a month where Venezuelan oil potentially displaces Canadian market share in the US refinery system that Canadian producers have been discounted to serve for 4 decades. The Asian buyers who have replaced American refineries as the competitive alternative for Canadian crude are not purchasing out of diplomatic goodwill or geopolitical alignment. South Korean state oil companies, Korea Gas Corporation, and SK Innovation buy Canadian crude because Trans Mountain gave them access to a reliable, non-sanctioned, deep-water accessible heavy crude supply at Brent-linked prices, delivered on schedule, without the supply disruption risk that attaches to Middle Eastern production through the Hormuz corridor or Russian production under sanctions exposure. Japanese trading houses and Chinese refineries are evaluating and signing long-term Canadian supply contracts for the same reason. Canadian reliability has a premium in a global market where Venezuelan supply is sanctions constrained, Russian supply is embargoed across much of the Western market, and Hormuz transit is demonstrably fragile. Canada is not selling commodities to Asia. It is selling the combination of commodity access and supply chain reliability that buyers whose industrial planning horizons extend decades cannot find elsewhere at this scale from a geopolitically stable source. That combination commands a price. Brent-linked pricing reflects it. The 40-year historical accounting of what the discount costs Canadian producers, governments, and pension holders is staggering when calculated against actual production volumes. At a $17 average discount across approximately 4 million barrels per day of production over 2 decades, Canadian producers left an estimated $25 billion per year on the table annually, not because the oil was worth less, but because the infrastructure to price it against global markets did not exist. The Alberta Heritage Fund, designed to capture oil wealth for generational benefit, could have been 3 to 4 times larger than it is. The CPP Investment Board's energy holdings could have compounded at higher returns for decades. Every Canadian who has collected a pension was, without knowing it, participating in a system that was systematically subsidizing American refinery margins through underbuilt export infrastructure. Trans Mountain proved the model works. $4 billion in additional annual industry revenue from narrowing the WCS discount by $3 per barrel through one pipeline providing one alternative market. LNG Canada proved it extends to natural gas, 1 million metric tons to Asia in April 2026, priced against global LNG benchmarks, not discounted American domestic gas prices. The Bridger Pipeline has 400,000 barrels per day in shipper commitments flowing toward American refineries that will now need to compete against Brent-linked Asian pricing, rather than dictating WCS discounts to producers with nowhere else to go. The era when American refineries received a structural pricing advantage on Canadian crude because Canadian producers had no alternative is now measurable in months rather than decades. The next westbound pipeline does not narrow the discount further. It eliminates it entirely. And American refineries, built to run on Canadian heavy crude, cannot replace that supply on any timeline that makes their capital investment whole.